Think your crypto transactions are invisible to the IRS? Think again. Whether you're mining, staking, flipping NFTs, or even earning money from gaming, Uncle Sam is watching, and he can track your every move on the blockchain even years down the road. I'm Jeff Hampton, asset protection lawyer, best-selling author of Investor's Blueprint, Asset Protection Made Simple, and founder of STR Law Guys. In this video, I'll reveal the hidden tax trips that could cost you thousands of dollars and the tax loopholes that could help you keep more of your money in your pocket. From classifying your crypto income the right way to legally reducing your tax bills, I've got you covered. Let's make sure the IRS doesn't come knocking. Here's the reality. Your crypto is not invisible. You've probably heard it said, I didn't get a 1099, so I don't even have to report my tokens. Or, hey, everything's hidden because it's on the blockchain. I want you to listen to me for a second. That is wrong. The blockchain is much more transparent than you might imagine. I know that crypto feels like you're anonymous, but in reality, every crypto transaction is notated on a public ledger. The IRS, predictably, already has teams and software that can easily track every crypto transaction on the blockchain. Here's the other thing. If the IRS suspects that you never disclosed your crypto gains, the IRS could actually come knocking well beyond the normal statute of limitations. 10 years from now, you could face back taxes, penalties, and interest. I get it. No one wants an unexpected tax bill. That's why it's so important that we understand how your crypto gains fit into your overall financial picture, and we need to understand it right now. Now, before we go any deeper into your crypto taxes, there are a few things you must have in order to get your financial picture all together. Now, the first thing we want to do is we need to make sure down here at the bottom layer, we need to have your estate plan or your living trust. Then over here on the other side, I want us to think about our operations of all that we do, whether it's our businesses, whether it's our financial operations. Then over here on the right-hand side, we want to be thinking about our assets. All of these must be taken into account for our overall financial picture. Let's start down at the bottom talking about a revocable living trust. For the most part, the wealthy are very smart about allowing most of their assets to flow down into that revocable living trust, except for maybe assets that are high risk. Maybe rental real estate, maybe you own an Airbnb, or maybe you have a boutique hotel, or something that could present a possible lawsuit. There we could talk about other strategies for protection, but otherwise we really want most of our assets to flow down into the revocable living trust, so that way you're organized and it helps you to avoid probate. Plus, come tax time, everything funnels up to your 1040, your personal tax return. The next area to consider is your operations over here. This would be your normal, ordinary income. Maybe you have a day job, a side hustle, or maybe an active business you participate in. Usually, this is where you get dinged with that 15.3% self-employment tax, if you're not careful. And then third, you have your assets, your passive income, assets like real estate, maybe your stock portfolio, and now we're talking about crypto. These assets typically produce passive income, which allows you to be on a different tax schedule, often at a lower tax schedule than your active income, unless you're involved in the type of daily mining activities that might be involved with crypto. Now, let's see how crypto fits into all of this. There's really two types of crypto activity we need to look at: active crypto and passive crypto. Active crypto is subject to self-employment tax. For example, mining or staking. This would be considered active. NFT creation, designing and selling your own digital art. Or gaming tokens, getting paid to play video games where sponsors or advertisers reward you in crypto. What does this mean? With active crypto income, you can pay not only your normal federal income tax, but the dreaded 15.3% self-employment tax as well. Pro tip here though, once your net profit crosses around $50,000, you really should consider setting up an S corporation for tax efficiency. Pay yourself a reasonable salary for what you do, and then take the remainder of the profit as distributions, and you can drastically reduce your self-employment tax burden. But what about passive crypto income? Here, this is subject to the normal capital gains tax rates, which many times can be quite a bit lower. For example, buying and holding Bitcoin, Ethereum, or other coins for long-term gains. Certain forms of staking that the IRS may consider passive. Trading tokens for profit, though short-term versus long-term gains can differ. What are the consequences of passive crypto income? Well, if you held your crypto investment for at least a year, it'll be treated as a long-term capital gain, which many times can be much lower, 20% in the tax range. However, if you end up actually buying and selling crypto over and over again during a less than 12-month period, you could be subject to the ordinary tax rate, which can be pretty excessive if you already have a high tax bracket. Pro tip here, if you're actively trading crypto, always keep meticulous records. Consider using special crypto tax software to help you keep up with your cost basis with your crypto, as well as the holding period, and maybe to also show that you only switched from wallet to wallet so that there's no confusion with the IRS. But what if you could trade or invest in crypto completely tax-free? It's entirely possible if you self-direct a Roth IRA or a solo 401k. One of the best benefits, no immediate taxes. Your wealth can actually grow tax-deferred, or if you use a Roth IRA, it could actually grow tax-free. But what about your kids? Believe it or not, if your kids are earning gaming income, they may qualify to set up a solo 401k for many of these advantages. It's possible if they set it up right, they could buy crypto in that account and allow them to build some serious wealth for their future. But be careful here. You're likely going to need a specialized custodian or a trust company. But the best part, once you get rolling on this and you set it up the right way, all of your crypto gains could potentially be tax-free, and it could establish some serious wealth for your retirement. Let's stop for a second and take the true story of Alex. Alex is a 15-year-old gamer, very talented, who discovered his opportunity to play on a play-to-earn platform. He jumped right into it and started accumulating tokens at $500 per month on part of this platform. And of course, there was no 1099 in sight. Because they never received a 1099, Alex and his parents ignored the tax obligations, and as the years just kept on going by, of course, those tokens went up in value. Of course, the IRS ends up tracking this down, sending them a notice, and Alex and his family have to pay not only the back taxes, but penalties and interest on that crypto. The right move here would have been for Alex's parents to treat this video game platform like any other business. They could track the earned income and perhaps set up an LLC or maybe even an S corporation here if the income gets high enough. By doing this, they could also set up a solo 401k or a Roth IRA for Alex to give him a head start on his financial future. The moral of the story here, don't ever assume you're off the hook just because you didn't receive a 1099. If there's a blockchain record, rest assured the IRS will find it. So let's take some specific action steps here. Number one, you need to identify your crypto buckets, whether they are passive or active income. Are you mining, gaming, or staking, or are you simply buying and holding? Number two, choose the right business structure here. If you're consistently making profits in crypto, it might be time for you to consider setting up that S corporation to not be stuck with such high self-employment taxes. And what about leveraging retirement accounts with your crypto? By setting up a solo 401k, a Roth IRA, or an health savings account, you could now possibly take some of your crypto gains and be able to either grow them tax deferred or maybe even tax free. Finally, always track your trades, your cost basis, and your wallet transfers, and make sure you get good professional advice from a CPA or an attorney that knows what they're doing so that you can make sure you're protected and not face an unexpected tax bill. Listen, in this day and age, crypto can be an incredible way to dramatically increase your wealth. As we see more technology and more adoption of these assets, you should consider them as part of your investment structure. But the downside, it can also be a minefield if you don't consider the tax strategies necessary in order to help you avoid that unexpected tax bill. Now, if you want to go deeper into tax strategies for your crypto assets and other assets, as well as how to make sure and protect them from greedy lawyers, check out The Investor's Blueprint, Asset Protection Made Simple, my new book that details all of these issues. But what if you're a real estate investor and you're looking at all of this saying, what are the specific tax deductions I should be considering in order to make sure and maximize my tax efficiency for my rental properties? Check out this next video where I break down the top 10 tax deductions for real estate investors. See you over there.